Welcome in, everybody, to our deep dive, this time into the world of smart money. Where is it moving in 2025? We've got a whole stack of research reports that we've been pouring over from some of the biggest names, Apollo, KKR, BNY Mellon, really top asset managers in the U.S., trying to get a sense of where they think things are headed and what that means for folks like us who are trying to figure out how to invest. But before we get into all of that, just a quick shout out to our sponsor for this deep dive, Trading Blitz. If you're even a little bit interested in trading stocks, you have to check out Trading Blitz. It's a stock trading simulator where you can backtest ideas, you can compete against other traders, see how you would have done in all these different crazy market environments. They've got a free account to get you started, or you can upgrade to premium to unlock some really cool features like filters and their proprietary trading algorithm. So check them out at tradingblitz.com. And one more thing before we really jump in. Remember, folks, this is for educational purposes only. This is not financial advice. We're just here to have fun, explore some ideas, and try and understand what the smart money is thinking.
Sounds good.
All right, so let's set the stage. 2025, what kind of year is it shaping up to be? When you look at the global economic landscape, one thing that jumps out is contrasts. The U.S. economy seems to be showing some resilience, while other regions are facing some pretty strong headwinds. KKR even uses this interesting analogy. They call the U.S. the nice house in a bad neighborhood. What are your thoughts on that?
Yeah, I think it's a pretty apt description. It really highlights that unevenness in the global recovery. On one hand, you've got the U.S., strong asset prices, record levels of household wealth. But on the other, you have so many other countries that are battling with inflation, political instability, rising inequality.
Yeah, it's like almost two different economic realities playing out at the same time. Mm-hmm. Makes it even tougher to kind of figure out where things are headed. Some experts are saying, we're moving towards some sort of global equilibrium, but there are others who are worried that these diverging trends could actually create more instability down the line.
Yeah, I think that's definitely a possibility. And, you add another layer on top of that, which is, the divergence we're seeing in global monetary policy. Central banks are all doing their own thing.
Yeah.
Makes it even harder to predict what's going to happen in 2025.
Yeah, it's like you've got the Bank of Japan actually raising rates right now, and then you've got the European Central Bank cutting rates faster than the Fed. I mean, that's pretty unprecedented. It's like, how do you even make sense of that in terms of like what the ripple effects are going to be? So with all this uncertainty, where are savvy investors putting their money? What are some of the big themes that we're seeing emerge from these research reports?
Well, let's start with credit markets. One of the big players in the credit space, Apollo Global Management, suggests that credit markets are actually entering 2025 in a surprisingly strong position.
Really? That's interesting because given all the economic and geopolitical uncertainty we just talked about, I would have thought there'd be a lot more pessimism around credit.
Yeah, you would think so, right? It seems counterintuitive, but Apollo is making the case that both the technical backdrop and the fundamental backdrop for credit are actually quite solid right now, even though spreads are tight.
Okay, so what's the catch? There's got to be some challenges on the horizon, right?
Well, there's always a catch, isn't there? One potential challenge that Apollo highlights is this huge wave of sub-investment grade debt that's set to mature in 2026 and 2027. We're talking over $620 billion worth of debt coming due.
Wow, that is a huge amount of debt that could create a real crunch for companies that need to refinance.
Exactly. And this is where things get interesting because Apollo sees this as an opportunity for private credit to step in and play an even bigger role in the credit markets.
Yeah, private credit has been gaining traction for a while now, but it sounds like it's really poised to become like a major force in the coming years. Mm-hmm. For our listeners who maybe aren't familiar, can you just quickly explain what private credit is and why it's becoming so important?
Sure. So private credit basically refers to loans and other forms of financing that are provided by non-bank lenders. So think private equity firms, hedge funds, specialized credit funds, these types of institutions. And they often step in to provide financing to companies that maybe are having trouble getting traditional bank loans, particularly, in situations like the refinancing wave that we just talked about.
So in a way, they're kind of filling the gaps left by traditional lenders.
Yeah, it's a good way to put it. And Apollo is predicting that this trend is only going to continue. They see private credit expanding beyond just sub-investment grade companies. They even see opportunities for private credit to provide financing to investment grade companies, especially in sectors that need more kind of customized financing solutions.
Yeah, you mentioned sectors that need customized solutions. Yeah. One that comes to mind is data centers. With the explosion of AI and data usage, the demand for data centers is just growing exponentially. I was reading about this in BNY Mellon's research, and they are predicting a massive need for investment in this sector.
Yeah, BNY Mellon's not alone. Ayers Management, another big player in the private credit space, is forecasting that we're going to need trillions of dollars in investment over the next decade just to keep up with demand for data centers.
Trillions. That's a mind-boggling number, but it also suggests like a huge opportunity for investors, right?
Absolutely. The need for data center infrastructure is only going to intensify as we become more reliant on these data-driven technologies. But Ayers also cautions that investors need to be discerning when it comes to data center investments because the risks can vary significantly depending on the development stage of the asset.
So it's not just about like blindly pouring money into any data center project. You really need to do your homework and understand the nuances of this sector.
Exactly. Early stage data center projects carry more risk. It's kind of like venture capital, whereas later stage stabilized assets are lower risk but potentially lower return as well. It's about finding the right balance on that risk return spectrum.
Makes sense. So we've got private credit stepping in to fill financing gaps. We've got data centers emerging as this major investment theme. Are there other areas that are catching the eye of smart money investors?
Yeah, a few others. One that I think is particularly interesting is this growing interest in small and mid-cap stocks. Both Capital Group and AllianceBernstein highlight this theme in their research, and they're suggesting that there's a potential shift away from the mega-cap tech stocks that have dominated in recent years.
That's interesting. It seems like small and mid-cap stocks have been kind of overlooked lately. What's driving this renewed interest?
Well, one factor is the potential for growth. These companies, typically valued between $2 billion and $50 billion, have the potential to grow significantly. Much like the tech giants of today, they all started small and eventually became the behemoths that they are now.
So it's about finding those companies that are still in their growth phase and could potentially become the next Apple and Amazon.
Exactly. And there's also this sense that small and mid-cap stocks offer a wider range of opportunities, especially if investor sentiment starts to shift away from the mega caps. It's about diversifying your portfolio and not putting all your eggs in one basket.
Diversification, always a good strategy.
Right.
Any other investment themes that we should be aware of?
Yeah. Another theme that popped up in several research reports is this growing appeal of growth at a reasonable price stocks.
Okay, so these are companies that are showing solid growth, but they're not necessarily the hottest stocks on the market.
Yeah.
Their valuations might be more moderate compared to those companies with sky-high growth expectations.
Right. T. Rowe Price in particular is advocating for growth at a reasonable price. Stocks, they argue that these stocks offer a really compelling combination of growth potential and attractive valuations, especially in a market where so many other options seem overpriced.
Yeah, it's about finding those hidden gems that might be overlooked by investors who are chasing the latest trends.
Precisely. And T. Rowe Price actually has some data to back up their case. They found that historically, these types of stocks have often outperformed the broader market on a risk-adjusted basis.
That's compelling evidence. All right, so we've got a lot to consider here. Private credit data centers, small and mid-cap stocks, growth at a reasonable price companies. We've already uncovered a lot of interesting insights. The U.S. is this potential nice house in a turbulent global economy, the growing influence of private credit, the allure of potentially undervalued small and mid-cap companies. But now I'm really eager to kind of explore some more specific opportunities for 2025.
Sure. Yeah. Let's start with something we touched on earlier, just the exploding demand for data centers.
Yeah, Ayers Management is predicting a multi-trillion-dollar investment need over the next decade just to keep up with all the data that we're generating. Seems like a gold rush for investors.
Well, it's definitely got huge potential, but Ayers also emphasizes that data center investing isn't a simple game. The risks can vary wildly depending on the development stage of the asset. Think of it like a spectrum. On one end, you've got brand new data centers being built. Those require massive capital infusions, but they carry a lot of uncertainty. On the other end, you've got established data centers with long-term leases, stable cash flows, but the returns might be a little lower.
So where on that spectrum are the sweet spots for investors?
Well, Ayers suggests that investors who are focused on asset-based credit might find the most attractive opportunities in those later stage stabilized assets. They're already generating income, they have less development risk, and they often offer attractive yields compared to things like corporate bonds.
So it's about kind of finding that balance between risk and return, investing in the infrastructure that's already powering our digital lives, rather than, speculating on the next big data center breakthrough.
Exactly. Now let's shift gears and talk about a market that often gets overlooked. Japan. Carlyle believes that Japan's private equity market is actually brimming with untapped potential.
That's interesting. I haven't heard much about Japan being a private equity hotspot.
Yeah, it's been flying under the radar for a while, but things are changing really rapidly. Corporate governance reforms have taken hold. Companies are becoming much more focused on shareholder value profitability. This is creating really fertile ground for private equity firms. They specialize in identifying these undervalued companies, improving their operations, and then selling them for a profit.
Yeah, so it sounds like kind of a perfect storm for private equity. You've got companies that are more receptive to change, and you've got investors who are hungry for opportunities in a market that's been somewhat neglected.
Yeah, and the geopolitical landscape's also playing a role. Japan's seen as a safe haven in an increasingly uncertain world that makes it even more attractive to foreign investors.
Yeah, I can see why Carlyle is so bullish on Japan, but as with any hot market, there's always the risk of overpaying for assets.
That's a valid concern. As more investors pile into Japan's private equity market, competition intensifies. That can drive up prices and make it harder to find those truly undervalued gems.
Yeah, it's like that old adage about buying low and selling high. It's a lot easier said than done when everybody else is trying to do the same thing.
Exactly. Carlyle emphasizes that success in Japan is really going to require, building relationships, having a deep understanding of the market, and a proven track record. It's not a place for quick flips and easy wins.
So it's about being patient, strategic, taking a long-term perspective. Speaking of long-term perspectives, let's revisit this concept of growth at a reasonable price, stocks.
Yeah, these are companies that are, growing steadily, but not necessarily at breakneck speed, and their stock prices tend to reflect this more moderate growth, which makes them potentially undervalued compared to companies with those sky-high growth expectations.
So it's about finding those companies that are kind of quietly delivering solid results without all the hype and the inflated valuations.
Precisely. And T. Rowe Price believes that growth at a reasonable price, stocks actually offer very attractive risk-adjusted returns in a market where a lot of other options seem overpriced.
Didn't they have some compelling statistics to back that up?
Yeah, their research shows that since 1990, growth at a reasonable price, stocks have actually outperformed the S&P 500 index on a risk-adjusted basis. They've also experienced less downside volatility and recovered from drawdowns faster than the broader market.
That's impressive.
Yeah.
It suggests that there's real potential for investors who are willing to, look beyond the flashy high-growth companies and focus on those that are delivering consistent, sustainable growth.
Absolutely. T. Rowe Price also points out that these companies often get overlooked because they don't fit neatly into the boxes of, traditional growth or value investing strategies. This creates an opportunity for investors who are willing to do their homework and identify those companies that are kind of flying under the radar.
It's about finding those market inefficiencies, those pockets of value that others might be missing.
Exactly. Now, let's bring back another theme that we touched on earlier, the rise of private credit.
Yeah, we discussed how private credit is poised to play this bigger role in refinancing sub-investment grade debt. But it sounds like its influence is expanding even further.
Absolutely. Apollo Global Management predicts that private credit's going to continue to make inroads into the world of investment-grade companies, particularly in sectors like data centers that need those more flexible financing solutions.
So why are traditional lenders like banks, kind of losing ground to private credit?
Well, part of its regulation, after the 2008 financial crisis, banks faced much stricter capital requirements, and that made it harder for them to lend to certain types of companies, especially those with higher leverage.
So private credit firms have kind of stepped in to fill that gap, offering alternative financing options to companies that maybe don't qualify for traditional bank loans.
Exactly. And because private credit firms are typically less regulated than banks, they can be more nimble and creative in how they structure deals. They're also often willing to take on more risk, which can translate into higher returns for investors.
So it seems like kind of a win-win for both borrowers and investors. Companies get the capital they need, investors potentially earn higher returns. But as with any investment, there are always risks to consider. Private credit's a relatively illiquid asset class, which means it can be difficult to sell your investments quickly if you need cash.
That's a crucial point. Private credit's not for everyone. It's more suited for investors with a longer time horizon and a tolerance for some illiquidity.
All right, so we've covered a lot of potential investment themes here. Private credit, data centers, small and mid-cap stocks, growth at a reasonable price, companies. But it's important to remember that, higher returns usually come with higher risks. What are some of the potential pitfalls that investors need to be aware of as we head into 2025?
One of the biggest question marks looming over the global economy is the potential impact of Trump 2.0 policies.
Yes, several of our sources, Wellington Management Alliance, Bernstein, T. Rowe, Price, PGM, Double Line, they've all expressed some concerns about the uncertainty surrounding, Trump's return to the White House.
And it's not just about the specific policies themselves, it's also about the unpredictable way in which they might be implemented. For example, Trump's fondness for using tariffs as a negotiating tactic, that could disrupt global trade flows and create significant market volatility.
And then there's the question of tax cuts. While they can stimulate economic growth in the short term, they can also lead to larger budget deficits and increase the national debt over time.
That brings us to another potential risk factor highlighted by Bridgewater Associates, the growing U.S. debt and deficits.
But didn't Bridgewater also say that the total borrowing is actually around average despite these large deficits? How is that possible?
Well, Bridgewater explains that it's because private borrowing has been suppressed due to those higher interest rates that we discussed earlier.
Oh, so the government is borrowing more, but businesses and individuals are borrowing less, which helps to offset the increase in government debt.
Precisely, however, the key question is, how long can this dynamic last? If interest rates start to decline and private borrowing picks up again, could we see a surge in debt levels that ultimately puts pressure on the economy?
Yeah, that's a thought-provoking question. It's a delicate balancing act. If one side of the equation changes significantly, it could throw things out of whack.
Exactly. And that's why it's so important for investors to, stay informed about these macroeconomic trends and how they might impact different asset classes. It's not enough to just focus on individual companies or sectors. You need to understand the bigger picture as well.
Yeah, I agree. So we've got geopolitical risks, potential policy shifts, trade tensions, the ever-present concern about rising debt levels. It sounds like investors need to buckle up for a potentially bumpy ride in 2025.
Oh, volatility is inevitable, but remember, it also creates opportunities. As markets react to these uncertainties, there will be winners and losers. The key is to identify those companies and sectors that are best positioned to navigate the challenges and capitalize on the emerging opportunities.
So it's not about trying to avoid risk altogether. It's about understanding it, managing it effectively, and having a well-diversified portfolio.
Absolutely. And that brings us back to one of the most important themes we've discussed, the need for investors to think beyond the short term and consider the bigger picture.
It's so easy to get caught up in the excitement of, the latest market fads or to panic when things get turbulent. But as we've seen from all this research, the most compelling opportunities often lie in those less glamorous, more overlooked areas of the market.
Exactly, whether it's investing in the data centers that power our digital lives, or finding undervalued companies in Japan's evolving economy, or seeking out those steady growth at a reasonable price, stocks. It's all about having a clear investment thesis, doing your research, and sticking to your strategy.
And perhaps most importantly, not being afraid to go against the grain. Sometimes the most rewarding investments are the ones that everyone else is overlooking. Now I want to kind of step back and consider some of those bigger picture questions that are shaping the investment landscape as we enter this new era. One theme that really stood out in our research was this idea that, we're moving away from this period of relatively stable globalization and into a world of, heightened geopolitical tensions. KKR referred to this as the end of benign globalization in their 2025 outlook. And Bridgewater kind of echoed that sentiment, calling it a geopolitical regime shift.
Yeah, and this shift is creating a lot of uncertainty for investors, because a lot of the traditional assumptions about, global trade, capital flows, political stability, they're all being challenged.
Yeah, it's as if the old rule book is being tossed aside and we're all scrambling to figure out what the new rules are.
Yeah, that's a great way to put it. And this brings us to a really crucial question. How do investors navigate this new landscape where those old playbooks may no longer apply?
Well, AllianceBernstein emphasizes the importance of diversification and flexibility in a multi-asset portfolio. They argue that investors need to be prepared to adjust their holdings quickly in response to policy shifts and market fluctuations.
Yeah, it's not enough to just cling to the strategies that worked in the past. Investors need to be more agile, constantly monitoring the environment for signs of change and adapting their portfolios accordingly.
It's like sailing in uncharted waters. You constantly need to adjust your sails to the changing winds and currents to stay on course.
Very apt analogy. Now let's talk about another major force that's reshaping the investment world, artificial intelligence, AI.
Yeah, BNY Mellon highlights how AI is fueling this exponential growth of data centers, but it's also impacting the investment process itself.
Absolutely. Alliance Bernstein, for example, has been developing these AI-powered tools to help their analysts process massive amounts of data and identify potential investment opportunities.
So it's like AI is becoming both an object of investment through, companies developing and applying these AI technologies, but also a tool for investment, helping investors make more informed decisions.
Exactly. And this raises a fascinating question. As AI becomes increasingly sophisticated, will it eventually replace human investors altogether?
That's a big one and perhaps a topic for a whole other deep dive.
Indeed, but for now, it's clear that AI is going to play an increasingly significant role in the investment world, both in, creating new opportunities and in shaping how investors approach decision making.
So as we wrap up this deep dive into the world of smart money, what are some key takeaways for our listeners?
Well, I think the biggest one is that we're entering a new era of investing, one that's marked by, a lot of uncertainty, rapid technological advancements, and a shifting geopolitical landscape. Success in this environment is going to require, adaptability, a long-term perspective, and a willingness to embrace new ideas and strategies.
So it's about understanding the bigger picture,
Okay.
identifying emerging trends, and not being afraid to explore those less conventional corners of the market.
Exactly. And as a final thought, I want to leave our listeners with a question to ponder. What if private credit, this burgeoning force in financing, continues to grow and fill the void left by traditional lenders? Could it become so large and interconnected that it becomes too big to fail, posing systemic risks to the financial system, much like the big banks did in 2008?
That's a sobering thought and a crucial question for all of us to consider as we navigate this rapidly evolving investment landscape. Thanks for joining us on this deep dive into the world of smart money. We hope you found it informative and insightful.
It's been a pleasure sharing these ideas with you. Until next time, keep exploring and stay